Gold just hit $4,635 per ounce. Silver broke $90 for the first time in human history. And if you're not paying close attention to what is unfolding right now in the precious metals market, you might one day find yourself wondering how everything changed so dramatically without anyone breaking it down for you. What I am about to show you is not a typical commodity rally. This is a fundamental structural shift in how the entire global monetary system works. And the consequences are going to touch your savings, your retirement, your purchasing power, and your financial future, whether you decide to follow along or not. I have spent years analyzing commodity markets, currency crises, and central bank behavior. And I can tell you with complete confidence that what we are witnessing right now is the most significant precious metals event since the 1970s. The numbers are staggering. Gold is up 71.9%, 2% year over year. Silver has exploded 206% in just 12 months. We are talking about gains that took an entire decade to unfold in the 70s, compressed into just 2 to 3 years. That is not normal. That is not how markets typically behave, and it demands explanation. Before we dive into the data, let me explain exactly why this matters to you personally. Because this is not just about shiny metals in a vault somewhere, this is about whether your dollars will buy groceries next year. This is about whether your retirement account will maintain its value. This is about whether the financial system you have trusted your entire life is about to fundamentally transform. The stakes could not be higher. Let me start with the numbers that should concern every single person watching this right now. As of January 14th, 2026, gold is trading at $4,635 per ounce. 1 year ago, it was $2,696. That is nearly a $2,000 increase in 12 months. But gold is not even the most explosive story here. Silver has gone from $29.90 per ounce to over $91. Let me repeat that so it sinks in. Silver has more than tripled in a single year. The previous all-time high for silver was approximately $50, set back in 1980 during the Hunt brothers era. That record stood for 45 years. Silver did not just break it. Silver obliterated it and kept climbing. Now let me tell you what is actually driving this historic surge, because the mainstream financial media is giving you surface-level explanations about inflation hedges and safe haven demand. The real story is far more significant and far more concerning, and it involves a perfect storm of 8 different factors all converging at the same moment in history. Driver number 1. Central bank buying at unprecedented levels. Since 2022, central banks around the world have purchased over 1,000 tons of gold every single year. That is more than double the buying rate before 2022. China alone has been buying gold for 14 consecutive months, straight through December 2025. The People's Bank of China accumulated 42 tons of gold since November 2024. And here is what makes this truly remarkable. China kept buying even as gold prices exceeded $4,000 per ounce. When a central bank is willing to pay record prices for something month after month after month, that tells you they believe the price is going much higher. Or they believe they need that gold for protection against something far worse coming down the road. Think about why central banks would do this. In 2022, when Russia invaded Ukraine, Western nations froze roughly $300 billion of Russian central bank reserves. Read that number again. $300 billion in sovereign wealth frozen with a single coordinated action. Every central bank on Earth watched that happen and learned the exact same lesson. Dollar-denominated reserves can be weaponized. They can be seized. They can be frozen at any moment. Gold cannot. Gold is the only reserve asset that exists outside any single government's direct control. That is why 95% of central banks surveyed expect global gold reserves to increase in 2026. Driver number 2, the constitutional crisis at the Federal Reserve. On January 11, 2026, Federal Reserve Chair Jerome Powell made an extraordinary public statement that sent shockwaves through global financial markets. He disclosed that the Department of Justice had issued grand jury subpoenas threatening him with criminal indictment. Let that sink in for a moment. The chairman of the Federal Reserve, the most powerful central banker in the entire world, announced he is under criminal investigation by his own government. Powell characterized this as unprecedented political intimidation. He said explicitly, and I quote, "This is about whether the Fed can continue to set interest rates based on factual evidence, or if monetary policy will be swayed by political coercion and intimidation." That is not normal. That is not how the most sophisticated financial system in the world is supposed to operate. And global investors understand exactly what this means. When the independence of a central bank comes under direct political attack, confidence in that currency erodes rapidly. And when confidence erodes, smart money flows into assets that cannot be manipulated by politicians. That means gold, that means silver, that means hard assets with 5,000 years of history. Driver number 3, the silver supply deficit that almost nobody is talking about. This is the factor that most people completely miss because they think of silver as just a precious metal, but silver is also an industrial metal, and the world is consuming far more silver than mines can produce. For 5 consecutive years, from 2021 through 2025, global silver demand has exceeded global silver supply. In 2024 alone, demand exceeded supply by approximately 500 million ounces. That is a massive structural deficit. Where is this demand coming from? Solar panels, electric vehicles, 5G networks, artificial intelligence data centers. A single solar panel contains approximately 0.64 ounces of silver, and the world installed 380 gigawatts of new solar capacity in just the first half of 2025 alone. That is a 64% increase year over year. Electric vehicles use 67 to 79% more silver than traditional combustion engines. Global EV sales are up 21% year over year and accelerating. Here is the math that the market is finally waking up to. You cannot manufacture more silver quickly. Mining projects take 10 to 15 years from discovery to production. There are no shortcuts. There's no magic button you can push to suddenly produce more silver. Meanwhile, industrial demand is accelerating faster than anyone predicted. Solar photovoltaic manufacturing now consumes over 25% of the entire annual silver supply, and that number is growing every single year. Driver number 4, the physical shortage that proves this is not just paper speculation. This is not a futures market phenomenon. This is a real-world crisis of actual metal availability. COMEX silver warehouse inventories have dropped from 290 million ounces to below 210 million ounces. That is a decline of nearly 30%. Shanghai silver inventories are at 10-year lows. The Royal Mint in Britain is reporting 2 to 3 week delays on silver products. Major bullion dealers across the United States are showing out-of-stock notices on their most popular products. And here's the number that should terrify anyone holding short positions. Silver lease rates, the cost to borrow physical silver for immediate delivery, have spiked to nearly 40%. The historical norm is 1 to 2%. When lease rates hit 40%, it means there is essentially no silver available at normal prices. People are willing to pay 40% annualized just to access metal right now. That is a short squeeze in progress happening in real time. If you tried to walk into a coin dealer today and buy American silver eagles, you would find 2 things. First, they probably do not have any in stock. Second, if they do, the premium over spot price is 8 to 12%. That premium used to be 3 to 4%. The physical market is telling you something the futures market has not fully priced in yet. The disconnect between paper and physical is widening by the day. Driver number 5, geopolitical chaos on multiple fronts simultaneously. In the first 2 weeks of January 2026 alone, 3 major geopolitical shocks have driven safe haven flows into precious metals at unprecedented rates. On January 3rd, U.S. military forces captured Venezuelan President Nicolas Maduro in an overnight raid on Caracas. Gold jumped $113 per ounce that single day. Silver surged $4. On January 12th, President Trump announced via Truth Social that any country doing business with Iran would face a 25% tariff on all trade with the United States. Silver is up 10% since that announcement alone. And ongoing, Trump has stated that anything less than U.S. control of Greenland is, quote, unacceptable. Denmark has warned this could signify the end of NATO as we know it. The post-World War II international order is cracking before our eyes. And every crack sends more capital into the only assets that have survived every empire, every currency collapse, every geopolitical crisis in human history: gold and silver. Driver number 6, the platinum and palladium rally everyone is ignoring. While everyone focuses on gold and silver, the other precious metals are also exploding higher. Platinum is trading at $2,399 per ounce, up 77% year over year. Palladium has surged over 106% since the start of 2025 after hitting 7-year lows. What is driving this? South African supply constraints. 90% of global platinum reserves are located in South Africa. Those mines are deep underground, expensive to operate, and extremely vulnerable to power outages. The country has experienced severe rolling blackouts that have directly impacted production for months. Bank of America just raised their 2026 platinum forecast to $2,450 and palladium to $1,725. Driver number 7, expert price targets keep getting raised, and they keep being exceeded before the analysts can even update them. JP Morgan now projects gold at $5,055 per ounce by the fourth quarter of 2026. Goldman Sachs targets $4,900 by December. Citigroup released a forecast that silver could reach $100 per ounce by March 2026. That is less than 8 weeks away. And here is what should tell you everything you need to know. Silver has already exceeded the upside targets that HSBC published just months ago. The banks cannot keep up with the rally they are trying to forecast. Every time they raise their targets, the market has already moved past them. Now let me make this personal for a moment. I talked to a lot of people in their 50s and 60s who spent their entire careers building a retirement. They did everything right. They saved diligently. They invested in their 401k. They paid off the house. They planned for Social Security. And now they are watching the news every night wondering if the rules are about to change out from under them. Here is what I tell them. You're not crazy to be worried, but you are also not helpless. What you are witnessing is not random market volatility. It is a fundamental repricing of hard assets versus paper assets that happens perhaps once in a generation. The question is not whether precious metals will continue rising. The question is whether they will rise modestly or explosively. And that depends on variables we cannot fully control. What happens with the Federal Reserve investigation, whether geopolitical tensions escalate or de-escalate, whether the physical silver shortage triggers a true market crisis. Let me give you the historical context that explains why this matters so much. Goldman Sachs commodity strategists have explicitly compared the current gold rally to the 1970s bull market. From 1970 to 1980, gold went from $35 per ounce to $850. That is a 2,300% gain over 10 years. The drivers back then mirror exactly what we are seeing today. Political pressure on the Federal Reserve. President Nixon pressured Fed Chair Arthur Burns just like Trump is pressuring Powell now. Geopolitical shocks. The Middle East oil crises then parallel the Iran and Venezuela tensions now. Currency debasement, massive deficit spending for the Vietnam War, then parallels the massive deficit spending now. Institutional crisis. The breakdown of the Bretton Woods gold standard then parallels the threatened breakdown of Fed independence now. But here is the critical difference that every investor needs to understand. The 1970s rally took a full decade to unfold. The current rally has compressed similar percentage gains into just 2 to 3 years. That suggests either the underlying drivers are far more intense this time around, or we are building toward a sharper correction, or perhaps both. Let me tell you about the gold-silver ratio because it reveals something critically important that most people miss. For most of the past 30 years, the gold-silver ratio has averaged around 68 to 1. That means it took 68 ounces of silver to buy 1 ounce of gold. In early 2025, that ratio hit nearly 100 to 1. Silver was historically undervalued relative to gold by almost every measure. As of January 2026, the ratio has compressed dramatically to 50 to 57 to 1. Silver is outperforming gold by a wide margin, and historically, when the ratio compresses like this, it means silver is catching up after years of underperformance and the move tends to continue. Ancient civilizations valued the ratio at 15 to 1. If you believe silver should trade anywhere close to its historical relationship with gold, the current price still has enormous room to run higher. Now, let me address the risks directly, because I would be intellectually dishonest if I told you this rally has no vulnerabilities or downside scenarios. Risk number 1, profit-taking corrections can be brutal. In December 2025, silver plunged 9.5% in a single trading session. Gold dropped 4.5%. Margin calls forced liquidation across the board. Goldman Sachs estimates that January commodity index rebalancing required $5.5 billion of gold selling and $5 billion of silver selling. When everyone is long and leveraged, corrections can be brutal and fast. Risk number 2. The 2011 parallel is worth studying. Silver peaked at $49.82 in April 2011. Within days, it crashed to $35. By 2015, it had fallen to $18, a 63% collapse that took until 2020 to recover from. The current rally is built on better fundamentals, genuine physical shortages versus pure speculation. But the pattern of sharp reversal followed by multi-year decline remains a genuine risk that cannot be ignored. Risk number 3. Regulatory intervention can change everything overnight. The 1980 Hunt Brothers episode demonstrated that exchanges can change rules mid-game. They can raise margin requirements dramatically, they can impose position limits, they can restrict new buying. 8 banks have paid $1.27 billion in fines for precious metals. Manipulation between 2016 and 2025. 2 JP Morgan traders served federal prison time for spoofing. The market is not always fair or free. Risk number 4. Demand destruction is a real factor at these prices. At gold over $4,600 and silver over $90, jewelry demand in India and China is collapsing. Industrial users are accelerating efforts to use less silver per application through what they call thrifting. Solar manufacturers are using less silver paste per panel. Retail investors may be priced out or hesitant to chase at all-time highs. Risk number 5. Dollar rebound would hurt precious metals significantly. If inflation proves stickier than expected and the Fed delivers fewer rate cuts than markets anticipate, the dollar could strengthen substantially. Higher real yields make non-yielding assets like gold less attractive. Wells Fargo projects a potential dollar rebound in the second half of 2026 that could pressure metals. So what does all this mean for you practically? Let me give you 3 scenarios with probabilities based on current data and expert analysis. Base case scenario, 60 to 65% probability. Gold ends 2026 between $4,900 and $5,200 per ounce. Silver ends between $85 and $110. The Fed delivers 2 to 3 rate cuts totaling 50 basis points. Central banks maintain their 1,000-ton annual buying pace. Geopolitical tensions stay elevated but do not escalate dramatically. The rally continues, but at a more measured pace. Bull case scenario, 25 to 30% probability. Gold exceeds $5,300. Silver exceeds $120. The Fed independence crisis escalates further. Powell's successor is extremely dovish. Geopolitical shocks intensify with Iran military action or continued Venezuela chaos. The silver physical shortage triggers a true short squeeze with lease rates exceeding 50%. Industrial demand from solar installations exceeds all forecasts. Bear case scenario, 10 to 15% probability. Gold corrects to $3,800 to $4,200. Silver corrects to $65 to $75. Regulatory intervention forces mass liquidation. Geopolitical de-escalation deflates the fear premium. A deep recession crushes industrial demand for silver. The dollar rebounds sharply as the Fed delivers fewer cuts than expected. What can you do with this information? First, do not panic. Panic is never a strategy, but do not ignore the signals either. Second, if you have zero exposure to precious metals, that is itself a significant risk right now. The confluence of central bank buying, supply deficits, geopolitical instability, and institutional crisis makes some allocation prudent portfolio insurance against scenarios none of us want to see. Most analysts are now recommending 5 to 15% of portfolios in precious metals. Morgan Stanley's chief investment officer now endorses a 20% allocation to gold alone. That is far above the traditional 5% recommendation of past decades. Third, understand the investment vehicles available to you. Physical bullion offers no counterparty risk, but comes with 8 to 12% premiums and 2 to 3 week delays from mints right now. Gold ETFs like GLD with $98 billion in assets under management offer liquid exposure without storage concerns. Silver ETFs like SLV offer the same for silver. Mining stocks like Newmont and Barrick Gold offer leveraged exposure to metal prices. Barrick shares have surged over 180% since the start of 2025. Newmont hit an all-time high of $106 in January. At current gold prices, miners with all-in sustaining costs of $1,200 to $1,800 per ounce are generating margins of $2,800 to $3,400 on every ounce they produce. That is generational profitability. Fourth, stay informed from quality sources. The sources I have cited throughout this analysis, Peterson Institute, Penn Wharton, JP Morgan, Goldman Sachs, the World Gold Council, they publish research freely available online. Read it. Because the decisions you make in the next 12 months regarding your exposure to hard assets could determine your financial security for the next decade. The comprehensive evidence demonstrates this is not speculative excess. This is a fundamental structural shift in global finance. Central banks are buying at 2 times historical rates despite record prices. The silver market has experienced 5 consecutive years of deficits, with genuine physical shortages now manifesting. An institutional crisis is threatening Federal Reserve independence for the first time since the 1970s. Geopolitical fragmentation and resource nationalism are accelerating across the globe. Industrial megatrends, from solar to electric vehicles to artificial intelligence, are creating inelastic silver demand that cannot be satisfied by current production. The age of cheap gold and silver appears to be over. Whether gold reaches $5,000, $6,000, or corrects to $4,000 in the near term is ultimately less important than recognizing the structural drivers are intact and intensifying every month. The question is not whether there will be consequences from the current global economic instability. There will be. The question is whether those consequences will be manageable, or whether they will compound into something far worse. And here's the thought I want to leave you with. Every major currency in human history has eventually failed. Every single one without exception. The Roman denarius, the Spanish real, the British pound as a global reserve currency, the Bretton Woods dollar gold standard. Paper money is a promise made by governments. Gold and silver are payment with no counterparty. For 5,000 years, through every empire, every war, every financial crisis, precious metals have maintained their purchasing power while paper currencies have come and gone. The bill is coming. The only question is whether we pay it ourselves or leave it for the next generation to deal with. If you found this analysis valuable, subscribe for more deep dives into the forces reshaping global markets. Drop a comment with your take. Is this a sustainable bull market or a bubble about to burst? And share this with anyone who needs to understand what is happening before it is too late. The decisions being made right now in Washington, in Beijing, and central banks around the world will affect every person holding dollars for years to come. Stay informed, stay prepared, and do not let anyone tell you this does not matter. It matters more than anything else happening in financial markets right now.